Welcome to your daily news impacting the markets. Shares of Opendoor Technologies have been surging this week following renewed interest from activists and fresh enthusiasm from retail investors. On Wednesday, the company's shares rallied 43.27%, resulting in weekly gains of 91% and 161% over the past month. The stock's sharp move followed public comments from EMJ Capital founder Eric Jackson, who suggested the real estate tech firm, which pioneered instant cash offers for properties, could be worth as much as $82 per share if it executes effectively and restores investors' confidence. Jackson posted on X saying, quote, "If standing between a 50-cent stock and an $82 one is what it takes, and shareholders want it, I'll saddle up again for Open," end quote. He was referring to his prior stints as an activist investor at Yahoo, while expressing his willingness to re-engage if his efforts can lead to substantial upside in a stock. Jackson criticized the notion of a quick acquisition or capital restructuring as a path to value creation. He said, quote, "You don't get to $82 through M&A, you get there by grinding, executing, and proving the model," end quote, calling instead for a stronger operational focus. He further urged the company's CEO, Carrie Wheeler, to instill confidence among investors by buying shares in the open market, citing similar moves by Carvana CEO Ernest Garcia III. Jackson also outlined a step-by-step plan to restore investor trust, including scrapping any potential reverse stock split and bringing back company co-founder Keith Rabois, who echoed Jackson's statements, while referring to Wheeler as utterly incompetent in a post on X. Opendoor shares are down 96% from their all-time high in early 2021. And this is after the 161% rally over the past month. Jackson, who calls himself the Carvana hedge fund guy, referring to his early bet on the used car retailer at $21, which now trades at 1,576%, draws parallels between the two, with both having been beaten down from their all-time highs. In other news, ArchInvest CEO Cathie Wood has sounded the alarm over growing job market pressures, especially for new college graduates amid rising unemployment and the disruptive impact of artificial intelligence on entry-level roles. In a video shared by ArchInvest on Wednesday, Wood pointed to a troubling labor market trend, citing the Wall Street Journal's reporting on new grads struggling to land jobs. Quote, "We do know that AI is certainly hurting entry-level jobs," end quote, she said, highlighting that the unemployment rate for recent graduates has climbed from a recent low of 4% to around 6.3% or 6.4%. Wood offered direct advice to those entering or re-entering the workforce, saying, quote, "Start focusing on AI, there's a lot you can do yourselves," encouraging job seekers to upskill as automation reshapes hiring dynamics. She also noted that continuing unemployment claims are rising, a sign that many unemployed individuals are struggling to find work, even as initial claims remain stable. The comments first came during episode 69 of In the Know, ARC's monthly video series posted earlier this month, where Wood addressed broader economic issues. Last month, the Kobasi letter highlighted that the gap between Americans who say jobs are plentiful versus hard to get has narrowed to 11.1%, the lowest since 2017, excluding the COVID-19 spike. Economists view this as a warning sign. Historically followed by rising unemployment, the data now points to a potential increase in the U.S. unemployment rate to 6.0% in the coming months. Previously, Craig Shapiro also cautioned that AI could disrupt 25% of all jobs by 2030, a challenge he says the Federal Reserve is largely powerless to resolve. In other news, a longtime Palantir bull, Tom Nash, is doubling down on the stock following its 434% rally over the past 12 months, with a new 5-year price target of $1,000 a share, representing an upside of 562% from its current levels. On his YouTube channel on Tuesday, Nash stated bluntly, "This company is basically as good as they come." He highlighted the significant improvement in its finances over the past 3 years, starting with the 90% growth in its revenues, followed by earnings and free cash flow growing at 200% and 500% respectively. Nash notes that what was once labeled a meme stock in its early days has since seen a dramatic shift in its investor base, with institutional ownership climbing from 30% to nearly 60%. This signals growing conviction from traditional money managers, saying, quote, "It's not even a retail queen anymore," he added. According to Nash, Wall Street continues to be behind the curve when it comes to Palantir, saying, quote, "Wall Street never understood it. It doesn't really understand it now, except the fact that the price went up a little bit, end quote. He now says that his previous $500 price target for the stock is now his bear case scenario, which already represents an upside of 231%, followed by a mid case of $754, and finally a bullish price target of $1,000, saying, quote, 500 is the lowest the stock can be in 5 years, end quote. He emphasized Palantir's scalability, describing it as literally the entire software infrastructure for running LLMs on a big business. Despite acknowledging valuation concerns, he urged long-term investors to stay focused on fundamentals, not fear-driven narratives. He concluded saying, quote, never too late to buy good companies, good businesses, as long as you have a long-term horizon, end quote, citing investor Peter Lynch. An engineer working with Tesla has admitted that the company failed to keep crash records for its Autopilot advanced driver assistance system during a trial involving the death of a bystander after they were hit by a Tesla Model S on Autopilot in 2019. The EV giant did not maintain crash records until 2018, over 3 years after launching the Autopilot feature, Electric reported on Wednesday. The fatal accident took place in Key Largo, Florida in 2019 when George McGee's Tesla Model S blew past a stop sign at an intersection and crashed into a parked SUV while on autopilot as McGee looked down to pick up his dropped phone. The crash resulted in the death of Nibel Benavidez Leon, a 22-year-old woman. The plaintiffs filed a lawsuit against Tesla, alleging that the company misrepresented the feature's capabilities and safety, according to the report. The engineer Akshay Patak said in his testimony to the court that Tesla did not maintain records of crashes involving the autopilot feature. The news comes as Tesla had recently filed a motion to dismiss the lawsuit over the death of Leon, which was rejected by the court, saying that the plaintiffs can proceed with the motion to seek punitive damages from the EV giant. The company also faces a wrongful death lawsuit over a 2024 crash in New Jersey involving a Model S on self-driving mode veering off the road. The crash resulted in the deaths of 3 people. Tesla has faced scrutiny over its self-driving systems following a Tesla Model 3 getting struck by a train after it was stuck on a railroad track while in self-driving mode. The National Highway Traffic Safety Administration, too, is investigating possible traffic violations committed by the Tesla Model Y robotaxi on FSD during last month's launch event in Austin. In other news, on Wednesday, a trial began in Delaware where Meta platform shareholders are seeking $8 billion in damages from top executives. These include Mark Zuckerberg, Peter Thiel, and Sheryl Sandberg, and are in relation to alleged failures to protect user data following the Cambridge Analytica scandal. At the trial's opening, privacy law expert Neil Richards testified, saying, quote, Facebook's privacy disclosures were misleading, end quote, reported The Guardian. The non-jury trial is being overseen by Delaware Chancery Court Chief Judge Kathleen McCormick, who previously voided Elon Musk's $56 billion Tesla pay package. The lawsuit claims Zuckerberg and other board members failed to uphold a 2012 agreement with the Federal Trade Commission requiring Facebook to safeguard user privacy. What is the lawsuit about? The alleged oversight led to the 2018 revelations that data from millions of users had been harvested by political consultancy Cambridge Analytica, known for Donald Trump's 2016 presidential campaign. Following the scandal, the FTC fined Facebook $5 billion in 2019, citing violations of the prior settlement. Shareholders now argue that the company's leadership should personally reimburse Meta for that fine and related legal costs, totaling over $8 billion. The defendants, including venture capitalist Mark Andreessen and Netflix co-founder Reed Hastings, deny wrongdoing. They say Facebook hired outside consultants to ensure FTC compliance and that the company was misled by Cambridge Analytica. Zuckerberg is also accused of selling Facebook stock before the scandal broke, allegedly profiting by at least $1 billion. His legal team insists the sales followed a pre-approved trading plan designed to avoid insider trading. This is the first Caremark oversight lawsuit to go to trial, targeting board members for allegedly failing to monitor corporate conduct, a historically difficult legal claim to prove, the report said. However, Delaware courts have shown more openness to such cases, A similar case involving Boeing's board resulted in a $237.5 million settlement. And that's been your news impacting the markets. Make sure you subscribe and follow Benzinga daily to stay up to date.